So often a key forefront of these kind of seminars is the landlord. And again, going back to 2015, the main reason for running these seminars was a lot of changes that were coming in to affect how the profits of a landlord were taxed. But just to begin with, some basics, because quite often, again, we get asked questions by people looking to start out and acquire their first investment property. So the basics and how are the profits of a landlord taxed? So the main concepts are similar to that of any other business, in that this whole in exclusively principle will apply. So the income ought to be self-explanatory. Generally, that's going to be rental income, but also any other payments or contributions you get. So if a tenant pays towards the cost of a repair, that gets included as a taxable receipt, and then you'll get the expense to go against it. But the expenses that you can deduct, the general rule is they'll be allowable as long as they're wholly and exclusively incurred for the purpose of the property business, subject to a change, which I'll come on to in a minute. In lots of cases, I think this would be hopefully fairly obvious in that, let's say, buildings insurance. The only reason you'd get that is for the purpose of your business of renting a property out. Domestic items have their own category here, though, and included within that are things like curtains, blinds, carpets, white goods, furniture. And the rules regarding these have changed quite a bit over the years. But where we're at now is when you acquire a property, if it's got none of these items in, the cost of purchasing them do not get tax relief against your rental income. But once a property has all these items in, then the cost of replacing them subsequently does qualify for relief under that particular category. Repairs, maintenance, enhancements is always an interesting subject as well. That's because there are a couple of concepts which can apply here. If you spend money on a property, does it qualify for tax relief against the income, or does it qualify for tax relief against any sale proceeds and capital gains tax at a later point in time? The general concept here is a repair is something which returns the property to its original state or condition. But there are certain nuances to that, in that you are allowed to take advantage of improvements in technology. So a good example of that would be windows, where if you had an older property with single pane glass windows, it's natural now and probably mandatory really that you'd replace that with modern double glazing or potentially even triple glazing. So that by definition is an improvement over what you went before, but actually it's a replacement. You're repairing like for like. It's a window for a window. So that would constitute a repair. Enhancements are something which would generally be regarded as improving the condition of a property and potentially enhancing its value. Might typically think of them as being structural, but you could see as part of a major redevelopment, a significant upgrade in a bathroom or a kitchen could significantly improve what had been there in the past, in which case you're more likely to be veering into the enhancement territory and relief for capital gains cost. But we'd look at that on a case-by-case basis. There is quite a lot of overlap, and where there's some overlap, we'd look to obviously apply relief where it's more advantageous to do so. And then, of course, there are the borrowing costs, which in landlord terminology has become known as Section 24. This was Section 24 of the Finance Act 2015, when the government decided that it was going to remove borrowing costs over a period of time from that concept of wholly and exclusively. So we're in a position now whereby borrowing costs, which to all intents and purposes we mean interest, is not a deductible cost when working out your profit. I'll demonstrate what this means and the double impact in particular now with interest rates increasing. So before this change came in, when we had nice interest rates at perhaps 2.5% on a buy-to-let arrangement, we have a number of clients who will have probably a primary line of occupation, and their interest in property is typically secondary, so maybe a couple of investment properties. So 7-8 years ago, we might have been looking at a £10,000 profit. In that scenario, just sitting in a basic rate band of tax, 20%, so £2,000 tax liability. We're bracing ourselves for more bad news, I think, in terms from Bank of England later today. I suspect when looking to remortgage now for properties, you'll be doing well to get anything below 6%. So in that kind of same scenario, looking at this in the old way, you'd have been running at a loss of £500. But because of these tax rules, you actually on paper have a taxable profit of £17,500. The nasty implication here is that this is pushing this individual comfortably into higher rate tax, so 40% tax comes into play. Now, they did allow a 20% tax reducer to be claimed against the loan interest costs. The idea was that they didn't want to permit higher rate tax relief on loan interest. But it's had this inadvertent effect of pushing people into higher tax rate brackets. So it goes more than what was really originally intended. So in this instance, despite being loss-making, there would actually be a £1,500 extra tax liability to pay on the rental income, which would essentially push that loss position up to £2,000. And that position could be made worse if in this scenario the individual's claiming child benefit, because there'd be clawbacks as well. So a number of different ways in which this has impact. So someone in this position has got clearly some choices to make. Do you ride out the storm and hope that we might expect there could be a change of government in 18 months or less? Might they take a more lenient view or show some sympathy towards the property sector? Maybe at some point we'll get to a position whereby inflation's under control and interest rates come down again. But how long do you hang in there? I suspect this year is going to be a tricky year because I saw a survey last month which indicated that nearly 50% of landlords are actually contemplating selling some investment property at the moment. So you could see potentially the market becoming a bit flooded. So are you able to actually go into to sell at a price that would be acceptable?